Friends, today we are going to start with the concept, and name of the concept is callable security. Name of the concept is callable security. Let us have understanding that say what is the concept of the callable security and what kind of decision that we are going to discuss over here. In order to explain that, I take a small example like this. We understand that say basically for an organization, it is important to decide from where to raise the funds. There are different sources of finance available in the market: equity source of finance, preferential capital source of finance, debenture source of finance, long term sources of finance, short term sources of finance, medium term sources of finance. Like that, so there are number of types of financing and at the same time number of investments. Certain investments are required to be made for long term, certain investments are for medium term, and certain investments are made for short term. Like that, so the time period for which you are going to make the investment would be different. We understand that say over here that basically the concept of the financial management says that whatever the time period for which you are going to make the investment, based on that say you should be raising the financing. If at all you are going to make the investment for the long term purpose, then in that case you should be having the long term financing. If at all you are going to have the financing for the investment for medium term purpose, then in that case you should raise the financing for the medium term purpose. So whatever the investment that say you are going to make, based on that say you should be getting the finance. If at all you want to construct a factory building and you are obtaining a short term loan, then in that case it is foolishness. Why? Because the factory is not going to give you the return in the short time period. It is going to give return to you say over the long period of time. That is the reason, so whatever the investment that say you are going to make, based on that say you should be raising the financing. This is the concept that we have. Now, suppose the company requires the funds so for the long term purpose. Suppose company requires the funds for long term purpose, and for that it is choosing say the long term financing. In case of the long term financing, we have basically two sources of finance. One is given a name as own financing and another is given a name as debt financing. The term debt financing stands for so the committed sources of the finance. The company is having say the optimal capital structure. That is say a certain proportion is always from the equity financing and certain proportion will always be from the debt financing. That is the way there is a split between them. And that is what we understand is the optimal capital structure. Now we understand that say if at all the company has decided to go for the debt financing to a certain extent, and for the purpose of the long term, so the company is raising the debt financing, suppose for a time period of 20 years. Taking into account the current market situation, the rate of interest is prevailing in the market, let us say 12%. So at face value, so the security is issued wherein we have committed to the investor to offer the interest at the rate of 12%. After 5 years, suppose so the market rate of interest changes and the market rate of interest is 9%. My question to all of you is that what do you think? Now at this point of time, the security will be at premium or discount or it will be at par value? Yes, everybody answered correctly. That's why if at all the market rate of interest is going down, then in that case, this security will be at a premium. We understand that this company will have a kind of dependence. What kind of dependence? That say we have to pay interest at the rate of 12% for the remaining 15 years, even though the market rate of interest has fallen at 9%. Over here, we understand that the company would have a kind of like feeling that yet we have to pay interest at the rate of 9, that is 12 percentage, even though the rate of interest has gone down to 9 percentage. If at all it will purchase the security now from the market, then in that case it is required to be purchased at a premium. So ultimately it is going to be expensive. This is a situation which the company is facing. Considering this kind of situation, the companies have been given permission that you can issue the security with a callable feature. What do we understand with the information that the security can be issued with a callable feature? It means that the company is allowed to issue the security with a provision wherein at any point of time, comma, security can be redeemed by the company, full stop. The callable feature will give an entitlement to the company that say during this time period of 20 years, at any point of time the security can be redeemed, and that is given a name as the callable feature. Suppose after 5 years the rate of interest is, now friends, if at all the company is introducing this feature, then in that case, suppose the rate of interest is after 5 years increasing to 15%, or otherwise after 5 years it is reducing to 9%, then in which case the company will exercise this right in case of 15 or in case of 9. We can say that say if at all the rate of interest is falling down to 9%, at that point of time this right will be exercised, not otherwise. This is what we understand. Why? Because we understand that say when the rate of interest is falling down, at that point of time the company will have a point that it has to pay interest at the rate of 12%. Better we redeem the existing security of 12% and we issue the new security at the rate of 9%. If at all the rate of interest has already gone up to 15%, then in that case the company would be feeling that say we are fortunate enough that we have to pay interest at the rate of 12% only. This is what we understand. We understand that say in this case, when the rate of interest is falling down to 9% and the company is redeeming the security, at that point of time the investors will also have a point that if at all the rate of interest is increasing to 15%, then in that case we are incurring a loss. What kind of loss? We are receiving the interest at the rate of 12%, and say you are, and we forgot to receive so the interest at the rate of 15% which is there in the market. It is a kind of inherent risk that say you take when you issue the long-term security, and even we take when we make investment in a long-term security. If at all the rate of interest is falling down and you immediately redeem the security, then in that case we are not able to make the gain of getting interest at the rate of 12%. If the rate of interest is increasing, then in that case we are incurring a loss. Why? Because we are getting the interest at the rate of 12 only instead of 15. So investors would be quite dissatisfied for making investment in a security with a callable feature. So we understand that the company in this kind of situation will issue the security of the callable feature along with an additional point regarding the premium, in a way that the company will tell to the investor like this: we have raised funds from you for a time period of 20 years. We have raised funds from you for a time period of 20 years. During this time period, at any point of time, we have a right to redeem the security. But you don't worry, if at all we redeem the security in between, then in that case we are going to make the payment of premium. Just a minute. हाँ नायन भाई खबर નથી મને हाँ so if at all we redeem the security in between, then in that case we will pay premium to the investor. Remember that say we will make the payment of the premium only if at all we redeem the security in between. If at all we are going to hold the security till the end of the 20th year, then in that case we will not make payment of premium. This is the way so the security is made attractive for the investor. So we understand that say if a company has, don't write anything, issued a security with callable feature, comma, in that case the company may decide to reschedule debt finance, reschedule correct, that is current debt finance with lower cost of new debt finance, comma, and for that it is required to A, make payment of call premium, B, incur flotation cost for new issue. In short friends, what will happen? There will be certain advantages and there will be certain expenses. So we are required to do cost benefit analysis to decide whether to reschedule the debt finance or not. And that is what we are going to understand in this segment. Please write an answer. Sorry, a note first of all. Heading write down callable security. In that write down first point. A company is required to decide how to finance, comma, its required funds. Full stop. Second point, financing depends upon the time period for which funds are required to be invested. Full stop. It can be for short term, comma, medium term, or it can be for long term. Full stop. Third point, apart from this, the company is required to decide about proportion of own financing and debt financing. Full stop. Fourth point, in case of debt financing, comma, the company will have a fixed financial charges payment, a fixed financial charges payment for the time period for which security is issued. Full stop. Fifth point, if rate of fixed financial charges decline in the market, comma, the company is still required to same financial charges for the remaining period. Full stop. Sixth point, in order to solve the above situation, comma, the company may issue the security with a callable feature full stop. In that the company holds right to redeem security in between full stop. In that case, investors will have a loss, comma, so investor will be given a premium if the company will exercise its call option full stop. Apart from that, there will be additional payment of flotation cost for new issue full stop. At the same time, there will be a savings of financial charges. Seventh point, we are going to decide whether to reschedule existing debt finance or not. Full stop. Let us see the next question. X Limited has issued debentures of rupees 1 lakh. So information is provided about the company which has issued the debentures for an amount of 1 lakh. The rate of interest offered is 12%. That is the rate of interest offered to the investors. It is issued for a time period of 2 years. So the security will be issued for a time period of 2 years. Income tax rate is 40% and the redemption is at face value. Flotation cost of the issue was an amount of rupees 20,000. It is required to be amortized equally over a time period of 2 years. Calculate net cash flow for the issue of the debenture. So we are required to compute from the company point of view what is the net cash flow on issue of the debentures. Try to do answer of the question on your own. Let us have understanding how to make the calculation of the answer. Working note number 1. Calculation of annual amortization of flotation cost. Whatever the flotation cost that we are going to incur will be amortized on the annual basis. So over here, flotation cost divided by the number of years. The flotation cost is 20,000 and the time period is 2 years. So 20,000 divided by 2, that comes to an amount of 10,000 rupees per year. Rupees 10,000 per year. Next, calculation of net cash flow. In that, year 0, year 1 and year 2. That is the way we have to prepare the cash flow series. We will have the payment of interest. What is the value of the debentures? It is an amount of rupees 1 lakh. What is the rate of interest? The rate of interest is 12%. So over here 1 lakh into 12%. That comes to an amount of 12,000 for the first year and 12,000 for the second year. That is the way we will have the payment of interest. Then we will have the amortization of expenses. That is an amount of 10,000 for the first year and second year. Total of this two will be debited to the P&L account. That is what we understand is the expense before tax. 12,000 plus 10,000, that is 22,000. 12,000 plus 10,000 is again 22,000. Then we have expense after taxes, that is 60%. Why? Because 40% is income tax. That is an amount of 22,000 into 0.6. That is 13,200 for end of year 1 and 13,200 for end of year 2. Amortization is a non-cash expense. It will be added to compute the cash flow. So end of year 1 it is 3,200 and end of year 2 it is 3,200. So it is negative 13,200 plus 10,000. That is the way we will make the computation of the cash flow for first year and second year. So write down further with paragraph, calculation of net cash flow, comma, on issue of debentures in that year 0, 1 and 2. At the end of the second year, we will have the redemption value. That is an amount of 1 lakh. In year 0, that is a flotation cost. That is an amount of 20,000. Fine. Then cash flow which we have calculated above. End of year 1, 3,200. End of year 2, again 3,200. Year 0, that is issue price. That is an amount of 1 lakh. That's it. So this is what's the final answer of the net cash flow. On issue of the debenture in the year 0, the company will receive an amount of 80,000. End of year 1, there is a cash outflow of 3,200. End of year 2, there is a cash outflow of 1,03,200. This is the way net cash flow will be calculated.